So in a recent event that we just organized, Larry Fink, CEO of BlackRock, said, "The next 25 years are the era of India." It's wonderful to be here this morning, as I believe this is a pivotal moment for India's investment management industry. The introduction of an entirely new product category that for the first time gives millions of affluent Indians access to sophisticated investment strategies within the transparent, tax-efficient, and liquid structure of the mutual fund. I'm here today not to sell you a product, but to explain why SIFs exist, why they matter, and why this moment is the inflection point for this category to become a mainstream part of India's wealth-building ecosystem. So let me start with a simple question. What do you offer a client who has, let's say, 20 lakhs to invest, wants returns that are better than fixed deposits or debt funds, but doesn't want the full volatility of long-only equity? Today, you have three choices. You have the mutual funds. They're transparent, liquid, tax-efficient, and well-regulated. But they're predominantly limited to long-only strategies, and in some cases, arbitrage. If your client wants downside protection, sophisticated hedging, or outcome-oriented strategies, traditional mutual funds have a structural flaw. Then on the other side, you have PMS, so more flexible strategies. So they have long, short, some tactical hedging, concentrated portfolios, but they come with a 50 lakh minimum investment. There's some tax efficiencies because the capital gains are taxed at investor level for every trade, lower transparency, and often high fees. So for many clients in the 10 to 50 lakh range, this is simply out of reach or economically inefficient. Then you have the Cat 3 AIFs, ultimate flexibility, but with 1 crore plus minimums, lock-ins, and potentially the biggest issue, returns taxed at the business income at slab rate. So for a client that's, let's say, in the 30% tax bracket, earning a 20% total return in a Cat 3 long-short fund, the post-tax return drops to 8.5%, give or take. That's just above a fixed income fund with almost equity level of risk. So where does that leave our affluent investor looking for this 20 lakh investment? There's no obvious solution up until now, and that's where the gap is. And that's the gap I believe SIFs are here to fill. So if we think about what SEBI did in, was it 2025? They came up with the SIF, which, and I think a lot of thought was put into this, right? Because you start with not just enabling access, which is kind of the first piece here, because regulations are super important. We have, in a sense, I'm trying to get the right words here, right? We are able to pull in all of the, let's say, safety in terms of the knowledge of the regulations, the governance that goes with it. All of that was put into the SIFs, right? What do they actually offer? Let's talk about that. Now, firstly, the sophisticated strategies. So what can they actually do? Long short equity. So what I talked about in the AIFs, now you can do that within the mutual fund wrapper. Tactical hedging. There's also alternative asset exposures, so REITs, InvITs in ways that can't be used within the mutual fund structure. Outcome-oriented strategies. I talked about this a lot. So targeting specific risk-return outcomes. So equity-like returns with bond-like risk. These are some things that SIFs are designed to be able to deliver. And with things like that come with the wrapper that I talked about, so daily NAVs, transparent disclosures, the independent trustees. So that wrapper makes this super attractive to be able to offer these kind of sophisticated strategies. Tax efficiency, call that out in the middle, like that is potentially a game changer here. So for the SIFs that have more than 65% gross equity exposure, they get equity taxation. So that's your long term at 12%, 12.5%, versus a 30% slab rate in the Cat 3 AIFs. Short-term capital gains at 20% versus a 30% slab rate. So there's an example here that we have, very basic example. So this is just an illustrative example for someone that's invested, 25 lakhs in a fund that's delivering 12% annual return. And when you compare the SIF versus the Cat 3 AIF, that's just in the tax advantage alone, that's about 2.15% annualized. So they're seeing a 10%-ish total return improvement over the 5 years. So for clients, that's no longer marginal, that's transformational. And then coming back to the last piece that I had, which is the lower Mendy norms and better liquidity. I've talked about this before. So the 10 lakh investment point is attractive for the kind of the growing affluent population that we have here in India, versus the 50 lakh starting point for PMS or 1 crore for the AIF. There's also the interval structures, which allow redemptions twice a week. Some of SIFs already are daily liquidity. So that's already far better than a PMS or an AIF, which has lock-ins. And then also there's a potential for zero exit loads from first day. Some SIFs are already doing that, which means that there's no penalty for additional liquidity. So then why now? That's the second part. So if there's such a good idea, why didn't they exist 5 years ago? Why now? So I believe there's 3 converging tailwinds that make now the right time for SIFs. Firstly is the people, right? So India now has over 10 million households with an annual income of over 10 lakhs. So these are doctors, lawyers, business owners, senior corporate professionals, people who understand that equity or debt is a false binary and are looking for more nuanced solutions. I spent 2 decades at BlackRock in the UK before I came here. And in my experience, whenever a country's wealth base matures, demand shifts from simple products to more outcome-oriented strategies. The US saw this in the 1990s with the growth of kind of hedge fund strategies within the mutual fund construct. Europe saw it in the 2000s with the rise of alternative UCITS vehicles. India is seeing that moment now. The second point is on investor sophistication. That's growing faster than product innovation, I feel, right now. Clients today aren't just asking, what's the 3-year return? They're asking, what's the Sharpe ratio? What's the max drawdown? How did he perform during the 2020 crash? What's your downside capture ratio? This is a fundamentally different conversation than 5 years ago. Investors, advisors like yourselves are more educated, more data-driven, and more outcome-focused. They're ready for strategies that aren't simply buy and hold equities. SIFs meet that demand. They allow you to have conversations about risk-adjusted returns, downside protection, portfolio construction that go far beyond equity or debt. We lost a slide here. We'll hopefully get it back. The third one I kind of talked about already, the regulatory enablement, right? With SEBI. I'll get to the slide. So they didn't just allow SIFs. There was a lot of thought put into this. The 10 lakh minimum ensures that it's for affluent, informed investors, not mass retail. The mandatory NISM Series 13 certification for distributors, which many of you already have or are taking, ensures that advisors are equipped to explain these products. And critically, as I said before, these were structured as mutual funds, not AIFs, meaning that they inherit the governance, transparency, and tax framework for mutual funds. This wasn't an accident. This was a deliberate policy to democratize sophisticated investing without diluting investor protection. So what does this mean for you? Let me be direct. SIFs are not a replacement for your core mutual fund business. They're an upgrade to your value proposition. Here's why I think it matters to you. Firstly, they do offer a viable, accessible alternatives to PMS and AIF. How many times has a client grown their portfolio to 40 or 50 lakh and then said, I'm moving to a PMS for more sophisticated strategies, or even worse, I'm investing in a friend's AIF. Every time that happens, you lose not just the AUM, but potentially the entire relationship, because the PMS or the AIF might have their own advisors who co-pull the clients into their ecosystems. SIFs allow you to keep that client. You can now offer a long-short hybrid fund, a factor-based equity strategy, or a low-vol absolute return product within the mutual fund wrapper. And these they already trust, and they trust you as their advisor. They also enable higher quality conversations. I talked a little bit about this earlier. When you offer long-only equity or debt funds, every market correction becomes a crisis. Clients may panic. You spend hours trying to calm them down, and some still redeem at the worst possible time. SIS let you have that proactive conversation about downside risk management. So, for example, you could say, let's allocate 30% of your equity holding to a long-short fund that hedges the downside while still giving you equity participation. Or you could have a goal-based discussion. Your goal is to raise 2 crores in 7 years. Let's build a core satellite portfolio with 50% in flexi-cap that's giving you the core equity exposure, 20% in a hybrid SIF that's giving you risk-adjusted alpha, and the remaining in debt for stability. These aren't just reactive conversations. They are strategic planning conversations. And clients who feel that you're planning with them, not just selling to them, stay with you for decades. Finally, there's better economics. So for complex, hybrid, specialized strategies, which exactly is what SIFs are, the commissions can be higher than an equity fund because you're delivering a differentiated value to the client. It isn't about churning or pushing high commission products. It's about being compensated fairly for advising clients on complex strategies that require education, ongoing monitoring, and handholding during volatility. Let's add some global context here. And I'm bringing this from my perspective as, like I said, at 20 years from BlackRock. In the United States, mutual funds were historically long-only equity or bond funds. And in the late 90s, early 2000s, as investor sophistication grew and people wanted more than just buy and hold, the industry introduced the liquid alternative mutual funds. These were strategies like market-neutral equity, long-short managed futures, and all of them were within the 40 Act mutual fund regulations, which is very similar to what we have here in India with the mutual funds. Initially, skeptics said, retail investors aren't going to go for this. The hedge funds are too complicated. But by 2020, liquid alts grew to over $300 billion industry in the US. So that's 28 lakh crores. Why? Because advisors realized that these products solved real client problems. Retirees who couldn't afford a 30% drawdown in their equity allocation. Business owners who wanted equity-like returns but needed to sleep at night. Families diversifying their concentrated stock positions with some downside hedges. SIFs in India are charting a similar path. The model has been proven globally. And in India, we have the added advantage of the taxation, which I talked about earlier. And this makes the economics even more compelling than it was in the US. We've already seen an early validation of this. So in the 6 short months since SIFs have launched, they've collected over 10,000 crores in assets. And 76% of that has been in the hybrid category, which I believe, has the biggest value add in terms of the taxation benefit. Okay. So what do you look for in an SIF? Because not all of them are the same. So as the category grows, and it will grow fast, you're going to see dozens of SIFs come to market. So how does one evaluate these offerings, given that there are no historical benchmarks or track records to choose from? Let me outline how a client might think about this, because that's a perspective and a framework that I really like to use. So firstly, we think about, is the strategy rules-based or discretionary? Is it driven by a systematic, repeatable process? Or is it dependent on a fund manager's skill or sometimes gut feel? Rules-based strategies like factor models, quantitative long-short, or systematic hedging are more transparent, scalable, and resilient. You can stress test them. You can back test them. You can explain them to clients in plain English. Discretionary strategies aren't inherently bad, but they do carry that key person risk. If a star PM leaves, what happens to the fund? At BlackRock, we're anchoring our SIF strategy on systematic multi-strategy approaches using quantitative models, risk frameworks that have been designed for over decades at BlackRock globally. It's not a one-person show. It's a platform, a process, and a philosophy. The second question one might ask is, what's the downside protection? The whole point of an SIF is to offer better risk-adjusted returns than long-only equity. So ask yourself, what was the max drawdown in backtests? How did it perform during the 2020 crash? What's the annualized volatility target? If an SIF's historical volatility is 15 to 18%, like a Nifty 50, then what are you actually paying for? You could get that kind of return with a flexi cap fund for half the fees. And then look at SIFs targeting, I would say, low single digits in terms of volatility, so 2 to 4%, and maybe mid to high single digit, low double digits, so 9 to 11% in terms of returns. That's, I think, the sweet spot in the risk-return trade-off. Thirdly is liquidity. So how liquid are these? Some of them will offer quarterly liquidity with maybe 1% exit loads. Others might be twice weekly with 0 exit loads. Think of liquidity as a feature, not a bug. Clients will have emergencies, new opportunities, or they may simply change their minds. So make sure that the SIF that is recommended isn't a soft lock-in disguised as a mutual fund. And then finally, what are the costs? So this is from the client perspective. So looking at the total expense ratio, exit loads, performance fees. If you're paying, let's say, as a client, 2.5% to 3%, which is PMS level fees, getting the mutual fund liquidity and all of the oversight, that's totally fair and worth it. But if you're paying that to get a flexi cap type of return, which you could get for less than half of the TER, you're overpaying. So really looking for SIFs that are priced more competitively and are more transparent about what they're offering. So how are we approaching all of this? I said at the start, I'm not here to sell a product, so I'll keep this again at the philosophical level. At BlackRock, we see SIFs as a category building opportunity, not just a product launch. Across all our strategies, we're bringing 3 things to the table, and that's what we're going to be applying here as well. Firstly, the global expertise. BlackRock has been running long, short, factor-based, and outcome-oriented strategies globally for over 2 decades, managing trillions of dollars. We've seen what works, what doesn't, how to build strategies that survive full market cycles, not just bull markets. That expertise, the risk models, the portfolio construction frameworks, the factor signals, is now available in India, adapted for Indian markets, regulations, and investor needs. Our institutional-grade technology platform, Aladdin. All our strategies are built on Aladdin. This is the same platform that is used by BlackRock to manage over $12 trillion of assets globally. And if you include asset managers outside BlackRock, that's well over 20 trillion. Every workflow from an investments perspective is automated. Every risk limit is monitored. Every portfolio stress test can be called on demand. It's systematic, transparent, and auditable. Finally, we're looking to leverage Geo's reach to make investments accessible, not exclusive. Within the SIFs, we're not building it for 500, 600 ultra HNIs. We're building it for the millions of affluent households who deserve access to sophisticated strategies, but have been locked out by high minimums, opaque processes, and tax inefficiencies. And critically, we're looking to build this with you, the MFD community. We're planning to launch our SIFs with regular plans, and then follow up with regular plans across our mutual funds range. With these, we aim to empower you with tools, training, and ongoing support to make our funds a core part of your advisory offering. Let me try and bring this home. India's mutual fund industry is over 80 trillion rupees and growing at about 20% if you look at a 5-year average growth rate. Within that, the affluent segment, these 10 to 30 lakh ticket sizes, is growing even faster at 25 to 30%. As wealth compounds and higher earners enter these high income brackets. SIFs are purpose-built for this segment. They're not for everyone. They're not meant to replace your SIP business or your index fund recommendations. But for the 10 to 15% of your client base who are asking for more than just long-only equity, who want that downside protection, who are ready to pay for sophistication, SIFs are the answer. And here's the incredible part. You're early. We're just over 6 months into this category. Many MFDs probably haven't even heard of SIFs yet. Most investors don't know they exist. We have a 12 to 18-month window to really become the SIF experts in our city, in our networks, in our client bases. The MFDs who lean into this now, get the Series 13 certification, who learn the strategies and start having these conversations, they're going to be the ones that are capturing these 10 to 30 lakh ticket incremental sizes. So here's my ask. Get educated, understand how SIFs work, take the NISM Series 13 exams, attend sessions like this, read the offer documents, identify the segment of the clients in your book who fit the profile, the 10 plus lakh investors seeking to invest, getting better risk-adjusted returns, and open to strategies beyond plain vanilla equity or debt. Have the conversation. You do not need to just sell. Just ask the question. Are you happy with the volatility of your equity funds? Would you be interested in a strategy that targets similar returns but with much lower level of risk? Partner with AMCs who are committed to this category long term, not just launching an SIF because everyone else is, but because they believe in building a platform, a process, and a partnership with the distribution. India is building wealth at an unprecedented pace. SIFs are the next evolution of how that wealth gets managed, with sophistication, tax efficiency, transparency, and accessibility. And I look forward to building this together with you. Thank you.